Haven't we learned our lesson yet? Welcome to this week's edition of the Industry Leader Update by Reverse Focus. It seems that the collective memory of many Americans is short in the wake of the housing and economic crisis. Just how so? The Wall Street Journal recently reported that more homeowners are once again tapping into their home equity. As home values recover and interest rates remain artificially low, many are beginning to take out HELOCs or home equity lines of credit to fund home renovations, pay off higher interest rate debts, or to cover other expenses. This strategy may work well for younger borrowers with sufficient and stable income, but not for senior homeowners who are on a fixed income. Why the shift? First, the appetite for home equity remains in the market. Second, lenders seeking to increase their sales volume are providing what the consumer wants. Case in point, in the first quarter of this year, HELOC volume rose to $23.4 billion. That is the highest level of new home equity lines in credit since 2006, just prior to the market's collapse. Even worse, some lenders are allowing borrowers to take out lines of credit that exceed the borrower's home value when combined with the existing first mortgage. Haven't we learned our lesson? Well, perhaps not. As home values have mostly recovered, lending standards have begun to loosen once again, providing easy money. Now easy today, but possibly difficult to pay in the future. Columnist Anne-Marie Androdis writes, "Perhaps the greatest danger is that a drop in housing prices would leave homeowners owing more money on their properties than they would be able to sell them for in a pinch. Normally the down payment and any paid off principal provide a cushion." In other words, if home values do drop, many borrowers would find themselves underwater once again on their home mortgages. For reverse mortgage professionals, this opens the opportunity to discuss the strategic use of home equity. For the vast majority of senior homeowners, taking a HELOC makes little financial sense. First, there is no security of future access to the HELOC funds, as the lender may reduce or even eliminate the line of credit if home values fall. Second, the required payments of a HELOC further reduce the borrower's monthly cash flow. Not a wise choice for those who are no longer working or on a fixed income. Third, many holders of a home equity line of credit are unable to afford the fully amortized payments that often begin after 10 years from the loan's inception. Now, we're just beginning to see HELOC defaults rise from loans which were written in 2003 and 4. Rising home values and low interest rates are good news for borrowers, but we should advise prospects of all the potential ramifications. Now, what are your thoughts on the resurgence of home equity lines of credit and the opportunity that we can seize upon? Leave your thoughts in the comment section below and have a great week.